There are three aspects to building long-term sustainable wealth. And it really is just about doing a lot of the easy and simple things and doing them systematically over time. And now I know in a lot of the videos I talk about picking stocks and a lot of individual companies, and we talk about different questions an investor will face. But there's a lot easier ways to kind of set yourself up for success in terms of wealth, which I think is what we are all here trying to do, is to have more money in the future than we have currently. And you don't need to know whether or not Vantage Score is going to win out against FICO or Reddit is going to build a self-serve ad platform. These questions, while interesting to think about, and certainly questions that need to be answered if you want to invest in those names, they're not necessary to have more money in the future. There are easier things that I want to zoom out and make sure we address first before we get into kind of all of the nitty gritty. Because if you are picking a portfolio of stocks and managing money yourself, there's a lot of other aspects that you need to consider beforehand that are going to impact your financial future to a larger extent than, potentially whether or not one stock's going to be a 3-bagger, a 10-bagger, go down 50%. And so in this video, I want to talk about these three aspects of kind of money management that need to all go together. You need to be doing all of these if you want to properly invest at the end of the day. It's important to investing as well. It's important to building wealth. It's important to making sure that you have a secure financial foundation. And so number one is going to be kind of the financial planning aspect, which I'll talk briefly about. Number two is going to be wealth management or asset allocation, making sure you are properly allocated to the right asset classes and in the right amount. And then number three is going to be investment selection or investment management. This is going to be the part you're probably most curious in if you're like most of my typical audience. But I'm here to tell you that all three of these aspects are really important. So just give me a little bit of time to touch on all of them. And then we'll get into investment management and also this kind of principle I came up with, which I call the investment matching principle, which is really key to making sure you are properly diversified and you have the right allocation in various investments, which is a question I get all the time. How much money should I put in this stock? How many stocks should I have? A lot of these questions I will answer, as well as, maybe tell you some surprising things about ETFs and allocations there. And so a lot of that is in this video. And again, the point of all this is to not lose, the forest for the trees. I think we don't want to lose the forest for the trees or lose the trees for the forest. Either way, we want to zoom out and remember the big picture here, which is that the point is to have more money in the future. It doesn't matter how that happens, really. I mean, as long as it's legal, of course. We just want to make sure we're setting ourselves up for success in the future. And there's different things we could do today that are a lot easier than trying to get, a single stock question right. And so I want to just make sure we all here have the same sort of foundational building blocks. I have a little bit of an interesting experience in that, yes, as you know, I worked at Goldman Sachs. I worked at Capital Group on the buy side. So I have been an actual investor that's invested money, at multi-billion dollar funds. And I am also a registered investment advisor today, where I manage many, many millions of dollars, not billions of dollars yet, but many millions of dollars, and have clients that'll help do this with. And I want to just talk about all of this and kind of give away everything I would kind of tell a potential client or anyone who's coming for me for educational insight into what they should do with their money. So all of this is just educational. And so hopefully you find value in this, because I know my audience spans from, teenagers that are watching this that want to be an investor to a large portion of people in the working world. 25 to 45 is my biggest cohort of watchers, but there are also a large percentage of people that are in 65 and up. And so the lessons and what you take away, it's going to be obviously different depending on your age cohort, but I do think that this can still apply broadly. So let us get into it. So the first aspect that I mentioned is going to be financial planning. Now, very high level, what you should know is basically the difference between your essential expenses and your non-essential expenses. The reason why this is going to be important is it's going to allow you to know when times are tough, you lose a job, maybe there's a really bad recession, it will allow you to know what your kind of burn rate is on your own P&L. And I don't say P&L mistakenly. I do think it's a good idea for you as an individual to think of yourself as a business, right? Because if you're watching this YouTube channel, you're probably pretty decent at business analysis. And so take that same lens and apply it to yourself. What would your profit and loss statement look like? Your cash flow statement, your balance sheet. Think of yourself as a business. And when you are thinking of a business, there's going to be businesses that have growth expenses and maintenance expenses. Maintenance expenses are going to be, in this context, your essential expenses. These are going to be expenses that you're not going to want to cut. This is going to be your rent, your food, but education, everything like that. All of that should be considered essential. A non-essential expense could be, a $30,000 travel budget that you have. And so if things get tough, you could cut that. And so by you understanding what your non-essential expenses are, then that allows you to budget and understand what your emergency savings account should be. Now, kind of as like a rule of thumb, a lot of people will tell you you should have a 3 to 6 months emergency savings. I don't really know exactly where that number comes from. We could just think about this from first principles though. Let's say that you lose a job. How much money do you want to have and how much runway do you want to have in order to find that second job, in order to start over if you need to? You're probably going to want more runway than 6 months. At least I know I would. It would just make me feel more comfortable, especially if you have a family and other dependents that rely on you to bring money in. And so I like to advise closer to a year in emergency savings. There's not exactly a right answer to that, but that's roughly how you should think about it. If you're very conservative, or you're maybe in an area where if you become unemployed, it will take you a very, very long time to get a new job set up, then your emergency savings should be even more. And when you're calculating your emergency savings, I recommend you just do it on your essential expenses. And so that's why we needed that number. So if you're spending $100,000 in essential expenses a year, these are expenses you do not want to cut. You probably want to have that much, roughly speaking, in cash. That's just a rule of thumb. And cash could be, short-term treasuries. You do not want to take out duration on that, because if you take duration on that, they could potentially go down, basically. They become more sensitive to interest rates, so you could have a loss there. So you want it in a savings account or very short duration, 3-month T-bills. So that's just kind of the first aspect there. And the second one I want to touch on is, of course, whatever money you have left over from your expenses is going to be your savings. Very obvious, right? And so this is the same thing as a business having profit. So what do you do when you have profit? Well, if you're a good business, you invest that. And so you want to know what basically your own profit is going to be, what your savings are on a monthly basis. Or, if you work in finance and you get a big bonus, most of that goes into savings. You could look at it on an annual basis. You want to understand your own individual cash flows. And so once you have that number though, then you could start to think about how you can add it to your investment account over time. So there's going to be different distinctions, different investment accounts. I'm not going to touch on that in this video. If there's interest, I could touch on it in a future video, how to think about putting money to a 401k, a IRA, a Roth versus an individual brokerage account. We could cover that if there's interest. But what I want to note in the importance of this and why I'm talking about financial planning on a channel that mostly focuses on investing is because this is going to be your input into investing, right? So if you're thinking about allocating a portfolio into different stocks, ETFs, you might be cost averaging some over time. You want to think about how much money is coming into this portfolio and in what sort of duration, in what sort of amounts. Is it coming in once a year? Is it coming in every month, every 2 weeks? That's going to impact the way you allocate a portfolio. At least it really, really should. Because if you have money continually coming in, you can allocate a portfolio very differently than if it's just one lump sum and you're not adding anything to it. I don't think investors think about this enough, because you may be young and you may have $100,000 in your portfolio, but you just got a good job in finance. And so now you're saving $100,000 after tax. And so within a year, all of the money you're investing today will only be 50% of your portfolio. That maybe allows you to be more aggressive into certain allocations, into single stocks or equities. And so that's why you need to take that into account. Conversely, if you are 45 years old and you have, a $5 million nest egg, and at this point you're not saving quite as much because, your expenses have gone up a lot, and this is kind of all the money you have really, and you don't really expect to save much more until, maybe your kids are out of the house and college is paid for in full. Okay, that's going to be a very different way. You're going to want to manage that $5 million portfolio. And so all of this is things you need to consider. So just to summarize all of this very quickly, you should know what your essential versus non-essential expenses are going to be. You should have an emergency savings account that, if you want to be conservative, is 9 months to a year of your non-essential expenses in short-term treasuries or savings account. You're going to then also want to understand how much are you saving every month. Hopefully you have cash inflows, not cash outflows. If you do have cash outflows and you're not a net saver, you're going to have to figure that out. Basically, you're going to either have to figure out how to increase your income, whether that's a second job or something, or cutting expenses. And by the way, when I do talk to people, I never tell them to just like save as much as you can. I actually think that's not a great way to live life necessarily. I think it's more about making sure your spending and your money is serving you. Because there's no point to just like accumulating an unlimited amount of money. Even though maybe it's fun, Buffett seems to really enjoy that. But at the end of the day, it's also about making sure the money you have is serving your lifestyle, because, time runs out and we all only get one life. So it's all about making sure that your money is actually serving you and being well spent. And it's a harder thing to measure because we can, do a return on investment analysis to understand if an investment has a good return. It's harder to do that for you individually, whether or not a certain spending was good. But, maybe you do have a second car and it cost a lot of money, and you're paying, a garage to store it, and there's maintenance on it, and you realize that wasn't great. Or you have a second home and maybe you psychologically could never justify spending $50,000 a month on a big rental home. And so instead you bought a home kind of telling yourself it was really in part an investment, and then it really ends up costing you a lot of money. You have a lot of money sunk into it that can't be invested in stocks. And then you have a lot of maintenance, a lot of upkeep. It's a lot of work. You're paying property taxes, and you're only there also for about a month. And you realize like that's a poor way to spend money. Some of this too, it does get a lot into psychology, the way we'll kind of bucket different spending. Sometimes if we are buying a second home, we think of it as an investment, even though very often that return, it's not a good return. It's not a good investment, and it's a big cost sink. And you probably would have been better off just paying $50,000, even though it sounds like a huge amount of money, to rent a home rather than to actually buy a home, which you thought somehow was really getting you closer to your goals. And so a lot of different things we could touch on here in the future, but the big things that I want to make sure you understood as it's going to lead to the way you manage your portfolio is going to be how much your savings are, what are the flows into your portfolio, because it's kind of similar to like an investment management fund. They have flows they need to manage, right? They'll have inflows, they'll have outflows. If you have outflows into an investment management fund, that means they're going to have to sell stock. They'll be a forced seller. Sometimes a fund will have private assets. They'll have to liquidate those. That's going to be an issue. So all of these aspects you should be thinking of in your own personal financial life, basically. What are the flows into my own investment fund? Am I going to be a forced seller if, there's some sort of capital outlay coming up? Did I properly budget for all of the different expenses in my life? And then the second aspect we have is going to be wealth management or asset selection. So this really involves making sure that the money you have is properly allocated into the right assets. And so said a little differently, I don't know that we always think about it this way, but we want to make sure the duration of our assets matches our cash flow needs. And so if we think about bonds, it's a pretty easy example. A 5-year bond, at the end of the 5 years, it gives you your money back. So let's say you're planning a wedding and it's going to be in 5 years. You put all that money in bonds. At the end of the 5 years, when you need that money, you get the money back. Now, the tricky part is most investments do not have an explicit date when they give you their money back, right? So if you're invested in stocks, other than, very rare circumstances where maybe there's a buyout offer, a tender offer, or something like that, you don't actually get back the principal amount of your stock, and there's no assurance you ever will, right? And so it kind of is like owning an open dated bond. And the only way you ever get liquidity from that, of course, is selling in the secondary market. But you don't know what price you're going to get in the future for that, because we all know prices in stocks are going to be very volatile. And so how much do you allocate to this asset class where you don't know when you're going to get your money back, and we know it's going to be very volatile? So there's actually some good research that answers that question. Generally speaking, you don't want to invest in the stock market unless you have a time horizon of 10 years. And so that means when I say that is going to be cash you actually need for some sort of purchase you can't defer in the next 10 years. That number, I'm guessing, seems a lot higher than most people would expect, but I'll talk about in a moment some of the research and why I'm saying that. To be honest, really 20 years is really what you want to be looking for if you want to be even more conservative. But I'll talk about the research in a moment. Just want to round out these other asset classes you can own. So then, of course, in addition to equities, and that includes whether it's ETF single stocks, there's bonds, that's going to be private credit could be included in that, but that's also going to be, regular treasuries, corporate bonds, high yield bonds, or junk bonds. All of that, fixed income instruments, that's one category. Now, the next asset class is going to be alternatives, which includes everything from commodities, private equity, real estate. Within that, though, let's take them one by one. Private equity, I'm generally not a huge fan of. Yes, there's some select funds that, do very well, great managers, and they don't kill you on fees. But by and large, if you think about it, there's not a big difference between owning a company that's public and private, right? I mean, a lot of these private equity funds are buying companies that are public and just taking them private. There's not really a distinction in business quality on average between the two. What advantage a private equity fund has is they're able to borrow money against cash flows instead of against the asset value. So if you are a public market investor and you want to leverage your position, you take out margin against it. And when you do that, the amount of margin you have to post, it varies with the stock price basically, and that changes all the time. That's what makes margins so dangerous, because the stock price could fall, then you need to put up more money in order to keep leverage in that position. So the advantage private equity funds have is that the leverage they do take out is going to be based off of the cash flows of that underlying business. So as long as that underlying business continues to produce cash in line with the covenants, they're going to be okay. They'll be able to continue to have that debt outstanding, even if the industry sells off a lot, like is what's happening in software right now, right? They're not going to ever have to get a margin call or something just because the public market peers of software sold off 50%. Instead, they will only have an issue if they violate covenants, which relates to the actual cash flows and financial status of the business. So being able to lend on the actual financials of the business instead of kind of the price, the perception of the value, that is a big plus. What ends up happening, though, when you are in a private equity fund is that they'll be buying these businesses, they'll be leveraging up them a lot. So that does actually improve your return on the equity. But then on the other side of that is they're going to be layering on a lot of fees. So they'll be layering on an asset management fee, usually around 2%, investment carry. So they're going to be taking 20% of your profits as well. Then they're also going to do something else, which I'm really not particularly fond of, which is that they are not going to actually take your money immediately, but they will take it whenever they want with a moment's notice. And this is called committing capital to a fund, but the fund doesn't take it immediately. And so let's say you have, a $3 million portfolio, and this investment advisor decides to put $300,000 of it into this private equity fund. Guess what? The private equity fund may not take it right then. They may wait 6 months to take it. Maybe they'll take 50 grand and then another 50 and then another 50. And a year later, they took another 100 and they waited until the market sold off, which would have been a great, perfect opportunity to buy stocks, but you can't because you have this capital committed. And it was at that moment they called it. So that's why I'm not a fan of that, because then they're also going to calculate their returns based off of not when the capital was committed, but based off of when they received the capital. And so if you know anything about how these returns are calculated, you probably instantly caught that means it inflates the return. So if you as an investor have $300,000 that's committed to a fund and you're sitting with it for a year, that time you're sitting with it for a year is not calculated in your return, even though you'd say that's kind of, BS because I had that money sitting there. Maybe it was in treasuries or something and it only earned 4%. And when they actually start the clock of counting the investment returns is once they pull the money to you, but you were already stuck kind of keeping it there for them. So that's another reason why I'm not a fan of that. A lot of kind of the IRRs are inflated basically as a result of that. And if you look at all of that in kind of the typical average multiple of invested capital of private equity, you're not really getting anything better. Sometimes it's worse than what the S&P 500 has returned historically. There's, a lot of the kind of the last cohort classes of private equity funds that were deploying capital in 2022. A lot of the returns there are probably going to be some of the worst returns for funds so far because they were deployed at this time when valuations were so high, interest rates were low. Now it's the opposite. And so interest rates are higher. The seller's not going to be able to pay as much or not willing to pay as much. And so not great. And that also, totally forgets the fact that your money's locked up. Could be locked up for 5 years, 7 years, 10 years. It's not always clear how long your money is locked up for. And maybe it's a 7-year fund, but they're able to extend it a few more years if they need that. So all of the is reasons why I'm not a huge fan of private equity, generally speaking. I would be fine owning the private equity managers, which is, by the way, what the founders of the company own. They own the management company, not the actual funds themselves. And those are great businesses, right? Because all those fees the investors in the fund paid, they go to you as an investor in the management company. And so I would be totally fine with owning a private equity stock, the management layer that's collecting all the fees. I wouldn't want to be an investor in the actual fund themselves. Again, there's some exceptions to great funds and all that. But if it is a great fund, then it's hard to get into. You probably won't be able to get much money into it. And then they probably also recognize their performance is great, so they jacked up their fees. So it's hard to win in that. The other two asset classes I want to talk about are going to be real estate, which I think in terms of cash flow is the best asset class that you could get. You have to be careful with how you get exposure to real estate. You don't want to directly own the property yourself because then you basically just bought yourself a job and it's going to be a lot of work. And a lot of the REITs, investment funds, the returns on them get bid down so much. Again, there's fees and everything else layered in there that the returns don't tend to actually be that much better. There's also not the same sort of tax benefits too if you're owning it in a REIT versus if you are a limited partner in different real estate holdings. And so there are tax advantage implications for that as well, depending on how you're owning it. So that's something else to take into consideration. If you do want actual cash flow, because generally speaking, it's either you're going for capital appreciation or you're going for cash flow. And a lot of investors get tripped up here where they think that if they need cash flow in order to live off of, their investments need to produce that cash flow. It's not necessarily true, right? So this is kind of a clear example. If we think about dividend stocks, what would be better? Owning a stock that, is probably not going to go anywhere, but pays a 5% dividend, but it's kind of a crappy business. It's not really growing. It's kind of in a challenged industry. Or owning a stock that doesn't pay any dividend, but it's at a very fair valuation and they're continuing to reinvest all their money at very high rates of return. My answer would be to own that second stock. That's a better business and just sell 4%, 5% of it a year, whatever it is you need. And there is usually a tax advantage. Now, it will depend whether or not it's qualified versus unqualified dividends. Qualified dividends will get a break on federal taxes, but at least in California, a lot of states, there's no distinction between the two. And so they'll just still tax you at the ordinary income rate. So usually some tax benefits too to owning that higher quality company and then just selling a portion of it every year. But of course, then, you are at the whims of the market being up or down. And so all that should be taken into account in kind of a bigger portfolio management, financial plan sort of strategy. But generally speaking, I still think that that's a better way to go, because even if you're selling a little bit of stock, when it's sold off a good amount, I think over time that's still going to perform better than you owning a very average or subpar business just because it issues dividends. And if we think about it, a lot of businesses usually issue dividends when they don't have reinvestment opportunity anymore. And so not always, but by and large, they tend to be companies that are more mature, have less kind of growth, less opportunity in the future. Now, there's some, companies that are certainly able to continue to grow and pay dividends. But if you're invested in a dividend fund, dividend ETF, something like that, I'm pretty sure a lot of them are going to be companies that are more mature, slower growing, and a lot of the cash flows they're making, they're paying out. And that's kind of the big reason investors will own that just because of that factor, not because of, whatever kind of growth that company may make on their retained earnings piece. And so just kind of backing up for a minute there, yes, there's a difference. If it's a cash flow producing asset versus a capital appreciation asset. If you do just want to live off of cash flows though, I do think real estate tends to be the best asset, mostly because depending on where the properties are, and yes, there's a business aspect to this. You do have to get someone who's competent, who's picking these real estate properties well, who's managing them well, and all of that. But the advantage is that rents can usually be increased, and so you're getting sort of a real return. And you own a real asset instead of bonds, which because of inflation can lose a lot of their value. Plenty of periods where bonds have lost, 20%, 30%, sometimes up to 50% of their value because of inflation. During one of the worst inflationary periods, bonds lost about 50% of their value. And, that could contrast to stocks, which over that same period actually gained 2.6% in real terms. It was a 30-year period they looked at for there. That stat comes from the Jeremy Siegel book, Stocks for the Long Run. And so generally speaking, if you are looking for income, bonds are just really tough because they quote the return in what's known as nominal terms. And so what that basically means is that they're not inflation adjusted. It's not a real return. So you could get, 5% coupon, and then all of a sudden 2 years later, inflation is 6%. And that 5% means that you're really actually losing money every year you hold it. And just by the nature of the bonds and the way they're priced, that bond will fully price down within that moment. So you have a big loss. And so bonds are thought to be safer, but it really depends the time frame you are looking at. I'll say a few more words on that in a moment, comparing it to stocks in the research. I just want to hit on commodities kind of as a last one here. So I personally don't allocate anything to commodities. It's a little bit of kind of the mentality Warren Buffett has, where he says, why would I want to own an asset that doesn't ever produce anything? For me, it's also just very speculative. I can understand a business and the cash flows it generates. I really just don't know how to price gold. I don't know how to think about, how much the demand for gold is going to outweigh the supply for it. A lot of it does just feed into people's emotions, which can then increase demand. That increase in demand leads to an increase in price, which then has a reflexivity aspect to it, which then in turn increases demand even more and then price even more and on and on. And so that to me, it's kind of just a different game. It does feel a little more speculative. I can fully understand if people feel comfortable having a little bit of gold, silver, metal exposure. That was actually when I was younger and started to get into investing. I owned a lot of gold and silver and all that. And to be honest, I saw it kind of just sit there year after year after year. And I realized, why am I owning this? I own the same amount of gold and silver I did several years ago. But Apple, I'm watching, them earn more and more money every year. And this wasn't just, the stock price going up. I felt better about owning something that I knew was producing value than retaining a portion of that value to then produce more value. It's this perpetual machine that, when done correctly, continues to just create more value. Whereas, metals, in contrast, don't do that. And, I know some people, they like cryptocurrency, Bitcoin, it's a store of value. My perspective on all this is I'm never going to tell someone not to do something. I want them to certainly be aware of the risk. There's no reason why a Bitcoin position, any of these cryptocurrencies, can't be flat for a long time, can't go down in value for a long period of time. Some people I know, they're evangelics and they're very, very sure of it. And so that's fine if they want to do that with a portion of their money. I wouldn't advise it be a very large portion, but people are going to have very different opinions on me with this. The way I kind of think about it though is, imagine as, an investment advisor, I told you, I'm going to put a lot of your portfolio in euros or yen. And you'd be like, what? Why? Why are you buying a bunch of euros? And I'll be like, oh, I think that this is the currency of the future. I did all my macro modeling and everything, and, euros, that's going to be a great store of value for the future. You just kind of be like, I don't hire you for that. That's not really your thing, Maybe there's a macro hedge fund out there that's run by Drunken Miller that you'll be like, yeah, I'll trust him to make a currency trade. But as an investment advisor, that's not something we should really do. I just don't believe in that because, again, it goes back to the fact that you're not buying something that's actually compounding in value. The only way you make money off of that is by selling it to someone else at a higher price, right? Which is inherently speculative. And so I'm actually writing this investor letter that should be out soon. It'll be one of my first investor letters that I've written. And I started off by talking about how there's two games in investing. One game is basically you make money off of people. So you try to buy something low, sell it at a higher price. And then in the other game, you are making money with people. You're buying a business. As the business grows in value, you continue to make more money. To me, only the second game is investing. The first game is speculating. That doesn't mean that there's anything wrong with playing the first game. It just means that, in my opinion, it's harder to do. And it also is something that is more likely to not work out. That's just my opinion on that. I do think the research kind of supports that a lot of people who do try to trade, it usually doesn't go well for them. I've played both games in my lifetime. I've decided I like the second game of owning appreciating assets that grow in value over time with cash flows, because that's something I understand. I'm able to, have some assumptions around what goes on in a business and model out those cash flows and have some confidence in it. I've never found anyone who's been able to very successfully do something similar for, a cryptocurrency or gold, even a lot of these things. Some people, they do model out, the supply of gold, the demand of gold, but that reflexivity aspect of it just makes it really tricky. And that's just not a game I want to play with someone else's money. That's not even a game I honestly want to play with my own money. Does owning some small amount of like gold or silver maybe make sense in an absolute worst case scenario, society melting down or something? Yeah, I don't know, maybe. I mean, as much as I do like looking at, the worst, most adverse scenarios, I don't actually look at a total societal meltdown when I'm thinking of how to allocate money, because in that scenario, all your securities could be worthless. Money itself could be worthless. And so, if you want a very small portion of gold or something, then maybe it makes sense to actually hold it physically. This, to me, it just feels like something outside of the realm of what, an investment advisor should be doing. It should not be helping you plan for nuclear Armageddon. I think instead it's helping you for the 99.9%, hopefully it's that high of a probability of other circumstances where, the world is not falling apart. So that's just my thoughts on that, on commodities and everything. So I don't personally own any exposure to that, nor do I advise it. People can have different opinions on this, and talk to your own financial advisor. I think I have to say that to get their take on it. But what I wanted to talk about was your allocations and how to think about allocating to these different groups. And so you probably got it by now. I'm mostly focused a lot on equities. People will have, a bond allocation to the extent that it's needed to fit into their short-term cash flow needs. Because as I was saying, if you don't really have like a 10-year plus time horizon on stocks and you need money on a shorter term time horizon, maybe you got a kid going to college in 2 years and you're going to need 70 grand for the next 4 years, I'm going to want to put that in bonds. I'm not going to want to risk that, stocks sell off 30% and it's kind of down that much even 2 years later, and I'm selling a lot more stock, and that $250,000 tuition is now 40% plus more expensive. Even though some people are okay taking that sort of calculation, I really don't like it. And I also think it's going to mess with your emotions as an investor. If you know you're going to need this money in a couple years and you keep seeing the thing go down every day, I just think it's going to lead to poor decisions. And so that's why it makes sense to me for the cash you actually know what you need it for on a shorter term time frame, the next several years. You start basically putting that into bonds, shorter term assets where you don't have this issue of, I don't know what it's going to return. But for the vast majority of your assets, if you do have a long time frame, I think equities makes the most sense. This again is drawing on Jeremy Siegel's work, but there's been no 15-year period where stocks have not fully recovered, and no 20-year period where stocks have not been positive in real returns. So that means after accounting for inflation. So when people are worried about inflation, which, is a worry, right? We've seen inflation is ticking back up a little bit right now, and it has not been fully stamped down. It's around 3.3%, something like that. That number is going to vary a lot, but inflation is a real concern because it eats against your purchasing power, ability to spend money in the future. I think stocks are just the best way to guard against that. But with real estate, there's an issue too. If you don't get long enough term financing, and what ends up happening when inflation rises is then the Fed tends to raise interest rates a lot. Maybe you're stuck refinancing at a very high interest rate, and hopefully you could raise rents enough to offset that, but you may not be able to. And so, generally speaking, I do still like real estate provided, you have the right manager, the right property manager who's managing it all, who's selecting the properties, but that's hard to find. And if it's someone's good at that, they're probably working at a fund, taking fees and all of that. And so a lot of that is getting rid of a lot of the benefit. And so stocks really are, for most people, in terms of just accessibility too, the best option to guard against inflation as well. Now, even if we're looking at kind of returns of stocks versus bonds, in 80% of all scenarios, stocks return higher than bonds. Again, this is going back to the Jeremy Siegel. I believe his data set goes back, at least over 100 years. And so long time frame we're looking at. So 80% of the scenario, stocks outperform bonds on a 10-year rolling period. If we zoom out even more to a 20-year period, then it's 90% of the time stocks are outperforming bonds. And then on a 30-year period, 100% of the time stocks are outperforming bonds. So there's kind of this thinking that stocks are riskier than bonds. And that's true if your time frame is only a year, 2 years, because it's going to be very volatile. The stock prices are going to be moving all over the place. Who knows what the market's going to do in a year? But if you have a long-term time frame, returns tend to gravitate towards a more consistent number, actually. Over a 30-year period, stocks are actually more consistent in a way than bonds, because bonds will vary a lot with inflation, with what interest rates are. Whereas stocks, it tends to be kind of consistent somewhat, how much they are actually growing as a business, how much the economy is growing as a business, how much earnings they're retaining as a whole, and their return on invested capital. And so that number tends to gravitate towards about 6.5%, which is what US stocks have returned for the past 100 years. If you go to global stocks, that number is a little bit lower. It's like a mid 5% number. And then bonds in turn return more like 2.5%. So much, much lower. So this, again, you got to pick what time period you're looking at and all of that. So there's a lot to this data, and you don't want to overfit to the data we have. And so the way I like to think about it is that if you were to live 100 lives, you want to be rich in 99 of them. You want to be rich in almost all of them. You don't want to take the path to wealth that required a lot of luck, buying a bunch of out of the money options on a penny stock and it just happened to hit. Most of the time, that's not going to work. That's not a reliable way to build wealth. And even if it works in one scenario, it's not going to work in the other 99. Whereas in contrast, saving money, regularly adding money to a savings account, adding money to stocks, and continuing to not freak out whenever there is a market meltdown, and just studiously adding money over time, that's going to lead to a great result in, 99 of the 100 lifetimes we're looking at. So how much should you actually put in single stocks versus ETFs? So I haven't really talked much about ETFs or just buying the market in general. But my honest opinion on it is that is a fine solution for a lot of people. I'll talk specifically about what I think single stocks do for a portfolio, but ETFs, provided you're picking the right ETFs, do provide a lot of diversification. And there's a low chance that things go very, very wrong when you're just buying a basket of 500 stocks like the S&P 500 or 1,000 versus if you only own 10 stocks or something like that. And I think most people who, they're thinking of Warren Buffett, Charlie Munger, who concentrated a lot in single stock positions. And I'll be honest, I do that myself too. At least relatively speaking, I do own some portion of ETFs as well. But I don't think for most people, the right answer is really to concentrate into single stock names unless you're really sure on the research you've done. And hopefully from a lot of the videos you guys have seen on the deep dives I've done, you can see that it's kind of hard doing deep research. And even in a lot of these stocks, there's still questions that are hard to answer. Not everything is going to be obvious or easy. And so if you are actually investing in stocks, you should really just be picking the ones that are the easiest for you. And that means you may be missing a lot of sectors and industries in the economy that you might want to have some exposure to. I think about companies like Tesla and Nvidia. These have been companies that have been very important to the S&P 500's returns. Except I'm going to be honest, I can't think of many worlds where I would have owned these stocks. I just am not good at assuming 100% plus growth rates into stocks. That's not something I really have ever found myself comfortable doing. And I don't think that's going to change into the future. But by owning some ETFs, I still had, some exposure to Nvidia, which I believe was responsible for somewhere around 1/3 of the market's S&P 500's performance in 2024. And so this happens every once in a while. There's these stocks that people don't really see it coming, and they just return phenomenally well. And you still get some exposure to that in the ETFs. You also get exposure to geographies that, maybe you're not looking at. You probably noticed I look at a lot of primarily US companies. Those are usually the easiest for me to understand because, the filing format, I'm standardized. I'm used to the SEC Edgar docs. I'm used to also, the way US companies operate and all that, the accounting under GAAP. And so I do have a preference for that. Now, that doesn't mean they're not diversified because, Microsoft is pretty diversified globally. Same with Meta. A lot of these businesses are, but you do still get more exposure to different geographies in the event that the US doesn't continue to be, the absolute best stock market that has ever been around basically for over a century. And so do I honestly think that that's going to change? Probably not, but it's not the worst thing in the world to have some exposure to these other geographies as well. And so I could talk more about how I think about the ETFs, my ETF allocation and all that, if there's interest in that in a separate video. You could think of it though, just kind of also like an anchor in your portfolio, some area where it's, do no harm. You have some portion into ETFs, it probably, just helps you not worry so much. But there's downsides to ETFs too. You're right now buying at all-time highs, which in and of itself is not an issue because markets tend to spend most time near all-time highs just by the fact that, when a business makes money, it makes cash, it retains that cash. And so once it retains that cash, it makes an investment on that, which should have a return. And so it should become more valuable over time, which is why markets spend so much time near all-time highs. But that is separate from the fact that valuations right now are about, 2 standard deviations out from, the historical norm of about a 17 times PE ratio. It's closer to, 21 times now, sometimes even a little bit higher depending on what exact index and estimates you're looking at. So it's expensive. And do you really want to put all your money into the market when it's this expensive? And so the general kind of financial rule of thumb you'll hear is that lump sum investing is better than cost averaging, which means putting all your money in at once is better than putting a little bit in over time. The problem with that is it's just looking at the past and it's a statistical analysis. So most of the time it's better to do a lump sum than cost averaging. Because if you think about it, the market usually goes up. And so getting more money in sooner when it goes up. Now, there are times though, where if you totally mistime this, like in 2000, your money is going to be lower for the next 12 years, basically. There's a brief period in 2006 where you would have been in the green, but then it would have went back down and you would not have caught back up to that until 2012. So if I was your investment advisor and I dumped all of your life savings into the market in 2001 at its peak and it didn't recover for the next 12 years, I don't think you'd be too happy with me. Having said that, if you're zooming out till today, you still would have done, quite decently, if you're looking at that whole 25-year, 26-year return. But I just don't think that that's the most optimal thing to do for most people. So I like to do a mix of it. I'll talk maybe in a different video about exactly how to figure out how much to invest in cost average over time. But generally speaking, I'll do, a smaller amount initially, depending on kind of the market index level, and then I'll cost average it over a longer period of time. But this also feeds into too, whether or not someone is constantly adding money to their portfolio or not. So that's another separate factor. And so why bother with single stocks at all? We all know the stats that like 99% of professional investment managers underperform, on any long-term time horizon plus the fees. And so why bother with the single stocks at all? So my answer to that is going to be that when I'm looking at a business and I'm able to understand what I'm comfortable with and see what those assumptions look like, I could then see what the cash flows are for the business and get a reasonable estimate of the return. Whereas in contrast, when I'm buying an index, I have no idea what the return is going to be. I don't. There's no way you could really actually figure that out. If you think about it, what's driving the return of the S&P 500, which is, returned about 10% on average or 9%. This is not inflation adjusted, but where's that coming from? A 10% return? Well, the economy is only growing 3%. So where's that other 7 coming from? Well, some of it is going to be corporate profits as a percent of the GDP have grown. So some companies are becoming more profitable. Okay, that's the other factor. What's the last amount of it? Well, it's basically multiples going up or said differently, it's interest rates going down and credit risk premiums being compressed. And so that's an aggregate take across the entire market of, what's happening. And I don't know if that's going to continue in the future. Charlie Munger, he was wrong saying this, but I kind of sympathized with it when he said, almost a decade ago that we shouldn't expect returns in the next decade to be as good as the last one. Well, they basically were, but the same still holds true now. The market has had a phenomenal run. We've been very blessed as investors with how strong it's been. And I don't know what you really would look at to have confidence in saying it's going to do the same thing again. I really don't. And that makes me kind of a little nervous. Whereas if I'm owning an individual business, I know, okay, this business just needs to sell this product to this many customers at, this price, maintain their margins, and their cash flow is going to be this. And if they buy back stock, I can pencil out a conservative return. There's actual things I could kind of grab onto and have confidence in when I'm looking at a business, which is why I, have a very, very high allocation to single stocks. Part of that's too, I feel I should eat my own cooking, but I do that because I feel more comfortable with that. Now, I think both are appropriate for most investors, and exactly what you're trying to do is going to depend on your own individual circumstance. And so some people will have 1/3 allocations ETFs, 2/3 to single stocks. Sometimes that's flipped. Some people, they may not want that many single stocks. And in that case, I'll only give them a few of the best ideas and mostly be in ETFs for them. It's really what's kind of also appropriate for that individual. Part of it is also just, what that individual feels most comfortable with, because it's very important that when you are investing, you do have this long-term time horizon, because, going back to those Jeremy Siegel figures, anything can happen in a 15-year period. But if you're invested for a period over than that, you're going to see, good results in all likelihood. And so it's really about making sure someone is comfortable enough to invest for that long period of time. Now, the last thing I want to say in this section is that when we talked about having those savings, planning out your emergency savings and all that, that does a very good thing psychologically for you as an investor. If you are able to know all of your capital needs are already accounted for, and something could go wrong in your job or whatever, you don't get a big bonus, and you still have a big cash pile, I think that's going to lead to you making better decisions in your investments and being more emotionally resilient, because you realize you have the staying power to invest for the long period of time. The absolute worst things that I've seen and the worst decisions is when someone has a lot of money that they may need for a wedding, college tuition, whatever it is, and they invest that in the stock market, and then the stocks start going against them. They start freaking out and they just sell it all, maybe down, 20% or something, like during, the Liberation Day tariffs, because they say, oh, this could be really bad and I need this money in a year from now. And, they just have to sell it because they weren't thinking ahead of time of the fact they needed that money for this other event. And so then, they totally sell it, and then the market rips up a bunch. And then at that point, they're saying, oh, maybe it's a safer market now. So they get back into it, and maybe they lose money again now with the Iran war, and they freak out again and sell it. And so by having your actual capital outflow needs accounted for, I really do think it will just make you a better investor. It'll help give you comfort when markets are tumultuous, and things could get much worse than what we've seen. If you read any history, you know that things can get so much worse than anything we've experienced. These drawdowns we've had have been very, very short-lived. We've had the COVID drawdown, the Liberation Day drawdown, the drawdown in 2022, but the next year, everything was way up. It was all better. That has not been the case always historically. So just also having an eye to history and how much worse things can be is going to be important, because we're going to see things in the future that have probably been much worse than what we've seen in the past 10, 15 years of investing. So when you are though selecting actual investments, this is going to be the third aspect we're talking about, investment management. So we had financial planning, wealth management or asset allocation. Now we're getting to investment management. This is going to be the actual selection of investments. So there's a little bit of a problem if you do work with an investment advisor where, in my opinion, a lot of times I don't think they're the best positioned to know whether or not an investment manager is good, because they're not usually really going to have the sort of analytical abilities to break down a stock, to break down a business that would allow them to ask the right questions to the investment manager to know how, good they are. There's also, these weird perverse incentives where if you are an investment manager, you're going to always want more money, basically. At least that's the way most people work, because they're going to take a percent of the assets. And so they don't turn away money usually. And so they're always going to be telling the wealth manager, now's a great time to invest. Now's a great time to invest. Give me more money, basically. And the wealth manager is not going to know any better. And so they will say, okay, sure, I'll trust you. And very often too, there's these perverse incentives known as placement fees or loading fees, and then also sales charges, where the wealth manager sometimes actually gets paid to put the investor in the investment manager's product. So it gets paid to buy someone a mutual fund, which is crazy in my opinion, because you don't want the incentives of, this wealth manager and how much money they're making to drive the investment selection for the investor, for the client. So that's something that happens though. And so very often, I don't think an average wealth manager is capable of selecting stocks. I don't think they should. And then of course, I'm talking against myself here because that's what I do as an investment advisor. And I do pick stocks for clients. But I think I'm a little rarity in that I have worked on the buy side, and you've seen kind of some of the research I do, which is very atypical for a lot of wealth managers. Very often they're more kind of like relationship managers. And I'm very not good at being a relationship manager, actually. I can't golf for crap. And also not the best conversationalist if it doesn't have something to do with business or investing. So very different in that regard. But when you are acting as your own investment manager and thinking of the investment selection, you have to think about portfolio diversification. So this is what I really want to hit on in this section. I'm going to assume everyone's kind of been inculcated with enough Charlie Munger and Buffett that they don't want to pay, fees for an investment management fund, a hedge fund, something like that, that's going to take 2 and 20 and underperform the S&P 500. But if you're not aware of it, you should know that most funds, they do underperform. They do take very large fees. And so if you are in a fund or, your advisor has you in your fund, you should definitely check out what those returns have been net of fees, because that 20% performance fee, that 2% asset management fee, it could really hurt your returns. Now, it's true too, though, that a lot of hedge funds, they don't try to beat the market. They're absolute return investors. And so they just try to make some money, usually 7% plus. It's kind of like the threshold they'll have, the watermark, in all sorts of variety of environments. But that also is probably not the best product for most people, because most people can handle volatility as long as they don't actually need that money in the short term. And so getting into, though, the actual investment selection and something I call the investment matching principle. Now, the idea behind this is you basically need to match the risk of loss to the number of independent investments you're making. And so I want to just explain this by example with bonds, because I think it makes it very simple and easy to understand. But let's say you want to build a bond portfolio for yourself, and the average default rate you've been able to calculate is going to be 5%. So that means that 5% of the time a bond is going to default. So let's say you bought one bond. What that means for your portfolio is 95% of the time, you're going to have all your money, and 5% of the time, you're going to lose all of your money. So that is not a good risk management strategy. So how do you mitigate against this? Okay, well, instead of one bond, you're going to have 100 bonds. And so that means, we said it's a 5% default rate. So 5 of these 100 bonds default, and you have 95% of your money. That's what's going to happen most of the time. Some percent of the time, maybe it's 6% default, maybe it's 7, maybe it's 3, maybe it's 4, but still you have, 90% plus of your money in basically all circumstances. And so that is how you use diversification in order to mitigate against loss. But let's think about that. That doesn't actually make you any money. So how do you make money on this? What should you price it at, basically? So what returns? So since the default rate's 5%, we're going to want at least a 5% coupon, because 5% of the time, bonds default. So if I had, a 5% coupon, 5% of my bonds defaulted, roughly speaking, I'm breaking even. Okay, well, that's not just how finance works. We also want to make a return. So if the risk-free rate is 4%, then we want to make at least 4% plus that 5% default rate, so 9%. So we actually want to make more than that 9% basically in order to invest in bonds. And so the two aspects here we're thinking about is, what does the return need to be to compensate me against a potential loss? But also, what is the proper amount of bonds in my portfolio I need so that if there are defaults, it's not a huge portion of my portfolio that's defaulting? Because again, if I only have one bond and there's a 5% default rate, that means 5% of the time I have $0. And so that's not a good strategy. And so how do you think about how many stocks you should own and all of that? It's a very tricky sort of question. If you are a VC investor, you're looking for stocks that have very, very high returns, 10x's, 100x's usually, and you're accepting the fact that almost all of your bets are going to lose. As a byproduct of that, that means you need a lot of bets because you need one of them to hit. In contrast, the way Warren Buffett invests is no single investment he believes is going to have a large impairment of loss. And so he can have fewer investments because he doesn't believe any one of them is that risky. And that means he's comfortable owning a dozen or so stocks and having one stock be a very, very large portion of his portfolio because he doesn't think there's a large risk of loss. And so the way you kind of match the risk of impairment of capital to the number of independent bets you have is what I call the investment matching principle. And the difference between a good and a bad investor basically is how well you are able to do this. Now, the word independent is a really key word because you need your risk to not be correlated. Because if we think about what the big mistake people made during the financial crisis was, it was that they were buying mortgage-backed securities that they thought were properly diversified because it was different people across different income stratums and across different geographies and maybe different home types as well. And they thought all of this meant that it was going to be a safe investment. It was uncorrelated. They missed the fact that though all of these mortgage-backed securities had one underlying similar risk, which was that home prices needed to continue to go up. Because if they didn't continue to go up, there would be massive defaults across the entire portfolio for reasons we could talk about maybe in a different video. But the idea there is that they thought they had all these independent bets, but it turned out they really just were making one bet on home prices and probably not getting a great return for making that bet either. And so you need your bets to be independent. As an investor looking at your portfolio, I advise you to not really focus that much on industry diversification or what geography your businesses are domiciled in. Instead, I think you need to look at actual specific risk and how many companies in your portfolio could be exposed to that same risk. You know, a couple examples I've said before are going to be if you own Apple stock, you have a big China risk in your portfolio because Apple has 20% sales exposure to China and basically its entire supply chain. So if something happens to the US's relationship to China, that investment could be at risk. If you have other investments that have, a China risk exposure, you want to include Apple as being a part of that. Another example could be if you own Snapchat, Pinterest, Reddit, or Twitter when it was public, and this thing called ATT was coming out. It turned out it impacted all of them and it hurt all of them. And so that had to do with ad tech basically changing the privacy standards. This was an Apple initiative and it impacted all of them. And so if you owned all these stocks, they were all exposed to this same risk. And so maybe you thought you were diversified because they're kind of different. Snapchat's more a messaging app. Pinterest is about, discovery and there's a high intent. And so it's kind of a different app and different people use it. There's more females that use Pinterest than, people that use Reddit. And so you thought that was diversified. It wasn't. And so I highly recommend you look at the actual specific risk. And right now, there's a big risk in the market that seems to be commingling a lot of investments. So it's hard, right? Then that risk, of course, is AI. AI is sending down stocks in software, in business services, and data analytics, really just having a broad impact. And so it's kind of hard to escape some risk. And so sometimes you have to accept the risk. You have to look at the risk relative to that individual business and make a decision if you think that that risk is something you're willing to accept or not. Now, from a portfolio management perspective, it does mean a lot of your stocks may be down at the same time. If you're invested in a lot of these high quality companies that were, trading at, kind of higher side multiples, and a lot of them came down at the same time, kind of feels like even though a lot of these were very different businesses from Copart, Brown & Brown, Constellation Software, I think Watsco goes in there. There's a bunch of them. A lot of them kind of came down at the same time. And some of that was a little bit of AI risk fear. Some of it was idiosyncratic things going in the businesses. But there was also an aspect where a lot of these stocks kind of traded together and they all kind of now went down together. Personally, though, that's not something I would really worry too much about in my portfolio, because that's not actually impacting the actual individual businesses. The AI thing could, but just because stocks tend to trade together or it's the same type of investor that owns something, that's not something I personally would really worry too much about. I'm worried about the actual risk that could impact the business. What are things that could actually hurt the cash flows of the business. That is what I would want to worry about. And when you're looking at your portfolio, you want these risks to be independent. And to really hit home this idea of the investment matching principle, I want you to assume that there's this investment that is either going to go to zero or it's going to triple in value. And there's a 50-50 chance of both. So if you own only one of these investments, this, goes to zero or triples, then either you're going to lose all your money or all your money is going to triple. Now, if you have the ability to buy two of these investments, now only in two scenarios are you going to lose all of your money. Now, if you're able to make 5 of these investments, your risk of total loss drops to just 3%. So there's only a 3% chance that you lose all of your money. And there's a 97% chance that you have at least 60% of your money retained. Now, if we increase this investment's return, so instead of it returning only 3x in the good scenario, it now returns 5x. So 50-50 chance of either being 0 or being a 5x. And we have 5 of these investments. Now we have a 97% chance of retaining 100% of our investment. So that basically means we need just at least one of these 5 investments to work. And as long as one of the 5 work, we'll have 100% of our money, right? And if 2 work, then great, and all that. So that is the idea behind the investment matching principle. You want the risk return profile of the investment to be matched to the number of independent bets you're making, the number of investments you have, and that will allow you to mitigate against risk in your portfolio. And so this is something I'm always thinking about when I'm allocating a portfolio. I'm thinking about what are the risks in it. And some of that doesn't just have to do with risk in the business. There is valuation risk as well. So if a stock is kind of overpriced, I'll take a smaller position. If it gets to a more moderate valuation, I'll take it up. If it gets to a very great valuation, it'll be an even larger position. There's also an aspect where sometimes it's my own confidence in the business that will dictate the position size. If I'm very confident in something, it'll be a larger position size. Sometimes something I've done some research on, but I feel like I could still do more research on, but it's also kind of cheap and I want to own at least a little bit because I feel pretty good on it, but I still feel like I want to read a little bit more before I take it up to a big position. So that's something else you could do as well. I like to basically vary my position sizing with what I think the expected returns are going to be, which is going to be a byproduct of the valuation and my assumptions I'm comfortable with, and then also be a byproduct of my confidence in it. And so that's going to be a byproduct of how much research I've done and how well I feel like I know the industry. There's going to be some areas where I feel like I can never have high confidence in it. And so those are just investments I'm going to have to pass on. That is fine. You should be passing on a lot of investments. You should not be taking hits on every single investment. Most of the time, the answer should be, I don't know, or no. Because the opportunities where you really feel good about it, you want to make the position sizing meaningful enough that it could actually make a difference, which is something else that needs to be remembered. Because at the end of the day, if you are really confident on something and it's a 2% position and it goes up 100%, you're only up 2%. Great job. Whereas, if you made it a 10% position, 15, okay, that's something notable. And this, again, it's going to go back to how you're managing your portfolio. It's also going to matter, how much risk you're comfortable with, because I don't care how confident you are in an investment. Things can always go wrong. And I've talked before actually about, Warren Buffett's salad oil scandal investment, where they basically, American Express, there was an offer out there and he thought that offer would be accepted. But if it wasn't accepted and instead it was litigated or there's other issues and fraud that came up, that could have been bankruptcy for them. And he accepted that risk, but it was a big portion of his portfolio. But when Warren Buffett managed money, he wasn't necessarily managing all of an individual's money. And so you are going to be managing all of your own money, or if you're working with a financial advisor, they're managing all of your money. And so the position sizing is going to be different than if it's just one investment fund that is a portion of an investor's money. So that's something else that you should keep in mind. Now, you need to basically be your own investment advisor if you're not working with someone. And it's hard. And the hardest aspect too is just the emotions of it. There are a lot of emotions and biases in investing that if you don't have someone else to talk through or work through with them, you kind of have to make sure that you're not going to mess yourself up on that. And it's just a very hard thing to do. Even Warren Buffett had Charlie Munger to balance himself out. And so that is going to be one of the more complicated aspects, but it is something you could definitely improve on. Now, if you want a summary of all of this, go to drewcohenmoney.com. You could sign up for the newsletter there. And I'm going to summarize all of this in a post in a week from now. The newsletter is free to sign up for. And if you want to learn more about those emotions and psychological biases that could trip you up, check out this video here. Or if you're ready to get back into some business analysis and try to pick some stocks, you can check out one of these business breakdowns here. And if you're enjoying this kind of content, go ahead and drop a comment below or a question if there's anything else you want to see. Thank you for watching.